Okay, everyone. So let's start a new topic today where we'll talk about financing decision, everyone. That is again a quite an important role. It will be, I won't say very high tested area, but yeah, it has been tested number of times in the exam as well. Or here, I'll leave some space for that and we can move forward. Now, the new topic, everyone, for today is the financing decision. Now, when I talk about financing decision, everyone, we all know that as a company, we have two choices. We have two important choices. One is debt and one is equity. And now we have to come up with our capital structure, which comprises of debt and equity itself, right? But what is the major reason behind coming up with a financing decision? I want my WACC to be as low as possible. What do I want, everyone? What do we want? We want ki my whatever is capital value, whatever is the value of finance, it should be as low as possible, right? Because whenever we raise finance, we have to go and pay off the cost of for it, right? We have to bear the cost. So what we do, everyone, we want to minimize WACC. Now, what is the full form of WACC, everyone? WACC is equal to, formula is very simple, don't get confused. As many number of equities or as many number of capitals you have, you just keep on adding. I am considering that we have only debt and equity, everyone. So value of equity upon value of equity plus value of debt 1 minus t. Over here multiplied by cost of equity. First step. Or sometimes you multiply it and then add, it is absolutely fine, doesn't matter much. Value of equity, अब यहाँ पे value of debt upon value of equity plus value of debt 1 minus t multiplied by cost of debt. If you have preference capital, you can add that as well. If you have bank loan, add that as well. Okay, you just keep on adding all the things over there. Now, this is the major thing that we do. We all know that equity is expensive, debt is cheaper, right? But I cannot keep my business, in my business, I cannot keep 99% debt or I cannot keep 99% equity. So we have to find a particular proportion of equity and debt so that my WACC is minimum. Okay, this is what our plan should be, what we have to achieve, everyone. For that, we have certain theories as well. Okay, for that, we have certain theories as well. First of all, we have, again, these theories are given by Modigliani and Miller. So Modigliani and Miller, what they did, they constructed a mathematical model to provide a basis for financial managers to make the financing decision. They said ki certain things. First of all, you might, if I talk about exam perspective, everyone, they might ask you to come up with the model. They will not ask you to prove it. Okay. So mathematical model predict outcomes that would occur based on simplifying assumptions. Comparison of the model conclusions to the real world observations allow researchers to understand the impact. I'll just write it down, that would be better. Generally, they have two theories which are more tested rather than this mathematical model. So I'll just copy paste it because it is not tested ever, first of all. Model. There are like number of assumptions which are given as well. So we'll just go through it once, everyone. Okay, so first point says ki it predicts outcomes that would occur based on simplifying assumptions. Comparison of the model's conclusion to the real world observations allow researchers to understand the impact of simplifying assumptions. By relaxing these assumptions, the model can be moved towards real life. So basically, a lot of assumptions have been used to come up with this mathematical model. And what are these assumptions? They are given below. We have already talked about all these things. We don't have to worry much. Now, these are the important theories. Now, what we are going to talk about, they are the important theories. The very first theory is, just give me a second. These theories are much better discussed in your books as well. So guys, the very first theory that we have is called as traditional theory. Okay, the very first theory that we have is called as the traditional view theory. Okay, we have the very first theory here, traditional view theory. Now, when I talk about this particular theory, guys, just remember one few things. Now, if I talk about this theory, which is the traditional view theory, okay, so when I talk about this traditional view theory, it talks about three levels of gearing. Okay, low level. It says ki at low level of gearing, my cost of equity and cost of debt will be low. ठीक है? At low level of gearing, what is happening? Cost of equity and cost of debt is low. I'll just try to create the I can take the screenshot, but I'm drawing it. At low level of gearing, guys, cost of equity and debt is low. Why should I write it? We can directly copy paste it. Okay, now if I talk about this thing, just give me a minute. Okay, now if you look everyone, at low level of gearing, my debt is constant and my equity is not going up, so that my total cost of capital is actually falling. Look, what is happening? I have some capital, I'm inducing more debt. What is happening then? My total cost is falling when I'm inducing more debt. Sir, why? Because debt is cheaper. First thing. Second, beta, at higher level of gearing. Now, what will happen? The equity holders will think, yeah, I am taking a lot of risk. I am taking a lot of risk, right? So now, if any more debt is induced, even I will ask for more returns. Even I will ask for more returns. Now, at very high level of gearing, but now equity holders are very tensed. They feel like, yeah, the company might become bankrupt. The company might become bankrupt. What will I do at that situation? I cannot get any returns. So what will they do? What will they do, guys? Even they will ask for more returns, or even they start selling your stock. So this is the traditional view of gearing, where we have three levels of gearing: low level, medium level, and high level, or very high level, which we call that. At low level, that is constant. Cost of equity does not go up that much. So overall, your cost of capital falls. Then you reach to an optimum level, which is called as point X, But we can reach over here. Sorry, we can reach over here using trial and error only. Using trial and error. This is the problem with this theory as well. We cannot directly reach there. We cannot directly reach there. Okay, so just read this once, everyone. And okay, sorry guys. So let's start with another part of theory, which is M&M theory with tax. M&M sounds like Eminem. I don't know why. Okay. So when I talk about M and M theory with tax, अब देखो, traditional view theory that is separate. Now we will have two theories, with tax, without tax. So he has given like two theories. At first, he gave his own theory that was without tax. M and M theory, that too without tax, everyone. So in that theory, it was like of no use. Why? Because there is no country in the world that does not have tax, right? So it was an absolute bogus theory but at that time it would have been good, but for the time being, it is not at all of use for us. So we'll focus more on the with tax theory. So now, according to them, if an investor is rational, right? We have rational investors. Now, what he said, कि यार, no matter how much debt you induce in your equity, how much debt you induce in your equity, it will always, the cost of capital will always keep on falling. The cost of capital will always keep on falling. This is the theory which is given by them. Now, what they said, कि यार, if the cost of capital is always falling, why don't you have 99.9% gearing? So he said कि it is better to have 99.9% gearing because the cost of capital will be lowest at that time. Will be lowest at that time. Right. Now, this theory sounded good, but it has certain problems. Why? Because it never talked about, first of all, bhai, if you have this much risk, मतलब this much debt, you will have bankruptcy risk, everyone. Correct. You will have bankruptcy risk. Now, having this much debt, your tax will exhaust. मतलब, beta, your debt is cheaper. Why? Because of the tax benefit as well. That will move on. Right. Now, risk of equity holders. You haven't talked about that part as well. Correct. Now, not only that, your cost of debt as well. If you keep on increasing debt, do you really think your cost of debt will remain same? Even that will go up at some point in time. Don't you think so, everyone? Your cost of debt will also go up. So this theory does not talk about these things. This was the major problem with this particular theory, everyone. Now we have certain other theories as well, guys. Over here, just always remember these diagrams and figures. In exam, they might test you to explain traditional view theory or explain the Modigliani and Miller with tax theory. Okay, they might ask you these things. So it is better that you always just read it once. Okay, I'm not asking you to go through and understand it in a very depth, but at least some knowledge you should have. Not only this, there might be a question when I talk about financing decision, there can be a question on raising finance. Ki whenever you are raising finance, what are the certain things that you should always take care of? That can be a question. Okay, that can be a question there. So these are certain things that we should always remember while understanding or while coming up with a theory. For example, if I talk about things that needs to be considered while raising finance, we have to talk about issue cost, we have to talk about gearing, tax, availability of finance, risk profile, covenants which are there. We might have to consider all of these things as well, right? Now they also gave us one theory which was with tax. This is with tax. They have also given one theory without tax. It is not talked. This theory is not talked about that much. As per this theory, guys, they talked about two companies of the same size and same line of business and same level of risk. But one company was ungeared, other company was geared. Now, according to them, both of these companies will have the same operating profit because they have the same market value and the same WACC as well. No matter whether the company is geared or not, they will have the same, everything will be same. Okay. They proposed or they argued about three things. They said that the cost of debt, if I can draw the figure. Okay, what they argued, everyone, that the cost of debt would remain same no matter whatever is the gearing level, it will remain same. Second argument, KE would increase at constant increase rate. Okay, it would increase at constant rates. Right. Now, what they said that the increase in KE would offset the cheaper debt. So your WACC will remain same. Listen very carefully, everyone. Dekho, when you are inducing more debt, your cost of capital is going down, right? But what is happening? Your cost of equity is going up. Why? Because of the risk and other factors. Now, what is happening? Let's say your cost of debt is going down by 5%, your cost of equity is going up by 5%. So after all, overall, your WACC is constant. Overall, your WACC is constant due to which the value of your firm is same. There is no change in the value of your business. Okay, there is no change in the value of your business. This is the theory with tax, everyone. They won't be testing you to come and solve any particular question, everyone. Okay. Now we have already talked about ki sir, we might have to adjust our WACC as well. Remember everyone, where we might have to come up with a new cost of equity if the business risk is changing, right? We have already talked about these type of question. If the business risk is changing, so we might have to come up with a new WACC, right? Let me talk a little onto the raising finance part as well, although this is something that we have already discussed in the past as well. Always remember there are like number of factors that we might have to use or considerations that we might have to give while raising finance, everyone. It is tested, so please make sure that you go through it. But don't worry about the theoretical topics, everyone. I will share you one note where I'll put down all the important theoretical questions. Okay, I'll do one thing, I'll share all the important theoretical questions with all of you. Okay, now there are certain other theories. Let's talk about that. First theory is called as static trade-off theory, which is something that we just talked about. A static trade-off theory. Now, as per this, whenever you induce debt, okay, whenever you induce debt, the debt will reduce the cost of capital because debt is always cheaper, right? But there is certain cost of that debt. Because you increase the debt, the risk of the company has gone up. Due to which what happened? Your equity holders might ask for a higher return. Your equity holders might ask for a higher return, everyone. This is one thing that can happen, right? That can happen. So always remember, above a target ratio, above a target debt ratio, you cannot go up. Why? Cost of debt and benefit of debt. Simple. cost of debt and benefit of debt. If you above a target debt ratio, if you go up, what will happen? You will have a financial distress, firm key value will decrease, the cost of equity will increase, and the benefit that you are getting because of the debt would not be there. Okay, that is one thing. Then we have one more, which is called as pecking order theory. Now, this theory is very simple, that whenever you want to raise finance, first of all, you raise from internal sources, यानी कि बेटा I am talking about retained earnings. Okay, after that you can go for debt. After that you can go for equity. First of all, you should raise from internal sources, then you can raise from debt, and then you can raise from equity. Okay, these are the three things that we can talk about. Up then there is one more theoretical topic which is called as gearing drift. Gearing drift, everyone. Now, what do we mean by gearing drift? देखो बेटा, we have certain ratio of debt and equity. We have certain ratio of debt and equity, right? Now, but this equity will hold what? It will hold retained earning as well, right? Now, let's assume that you are not doing anything. You are not paying off your debt. You are not raising any new debt. Nothing is happening. So now you will say, "Ki, sir, my gearing ratio should remain same." Right? What should you say? That my gearing ratio should remain the same, everyone. But beta, because your company will make profits, your retained earning will go up. Your retained earning will go up. Right? Now, because your retained earning will go up, your gearing will fall. But then there is a topic of signaling, which is not tested, but actually whenever you raise finance, it gives a signal. Okay. So basically, what do we mean by signaling? So whenever you raise finance, it gives a signal to investors that we are a confident company and we can go and raise finance, right? So basically what is happening, the firm is showing that they are confident and they have identified new projects and they will be able to afford that, right? That is why we are looking for new finance. So that is the signaling. Whenever you raise a new finance, it is presenting a signal to the investors. Okay. That is why whenever you choose your finance, it is going to affect a lot. It is going to affect a lot to your value, the value of your company as well. Okay. So these are the certain things that you will have to remember. And to cover it in a much better way, I would suggest you guys to please go through one of the chapters in your Kaplan that is called as financing decision. There are like lot of topics. Just brief discussion onto that. Just read it once and that would be good enough for all of you, everyone.